Hi everyone, this is Professor Gallagher, and this is the first video for Chapter 1. First of all, we're going to start with a brief introduction on how we came to the income tax that we know today. The income tax was first enacted in 1861 to fund the Civil War and was repealed after the Civil War ended. The income tax law was passed in 1894, but then was rejected by the Supreme Court the following year. The 16th Amendment to the Constitution was passed in 1913, and this is what has formed our modern income tax law. So in this picture, you'll see an example of what the original Form 1040 looked like from 1913. And you will see that as we go through this course that it is a lot more simple than what we have today. So the first thing that we are going to talk about are the different tax structures. Before we get to that, there are two components of a tax. The tax base, which is the amount that the tax rate is multiplied upon, and that is usually an income, a sales price or value. And then the sales and then the tax rate, the percentage. So taxes are going to be calculated by multiplying the tax rate, the rate of the tax, by the tax base, the amount that is being taxed. So there are three different types of tax structures. So we're going to start first with the progressive tax structure. In this structure, the tax rate increases as the tax base increases. An example of this is the U.S. income tax system. Next, we have the proportional tax structure. In this structure, the tax rate is going to remain the same regardless of the tax base. So an example of this is our state or local sales tax. So you're going to pay the same rate of tax regardless of whether you make a $10 purchase or a $10,000 purchase. With the regressive tax structure, the tax rate decreases as the tax base increases. An example of this is the Social Security tax system, because there is a threshold where higher earning individuals stop paying into Social Security tax. So to take a very simplified example at the three different tax structures, here you'll see across the top we have our income of $10, $20, and $30 going across the top. With the proportional tax rate structure, you'll see that the tax rate remains the same as the income level goes up. With the progressive tax structure, you'll see that the income tax rate increases as the income increases. Within a regressive tax structure, you'll see that the tax rate decreases as the income or the tax base increases. So let's go through a quick example. In this example, we have Jake, who earned $15,000 and he paid $1,500 of income tax. Jill earned $40,000 and paid $6,000 of income tax. The tax rate structure that they are subject to is progressive, because as the income level increased, the tax rate also increased. Jake paid a 10% tax rate, and Jill paid a 15% tax rate. So next we're going to talk about marginal and average tax rates. The average tax rate is the total tax paid on a certain amount of taxable income. So the formula for this is the total tax divided by taxable income is going to equal the average tax rate. The marginal tax rate is going to be calculated using the tax rate schedule, which is in Appendix F of your textbook. And this is the rate of tax that will be paid on the next dollar of income. So for example, in 2018, if you look at your tax rate schedule for married filing jointly, you'll see that a married couple will pay a marginal rate of 22% on their $74,401 of income. So let's go through a quick example. We have Jennifer and Paul who file a joint return in 2018. they have taxable income of $93,425. So their total tax liability is calculated as follows using the tax schedule. So their tax is going to be calculated as $8,907 plus 22% of their excess earnings over $77,400. So the first step will be to find out what their excess over $77,400 will be. So they earned $93,425. We're going to subtract the $77,400 to get $16,025 that is going to be subject to the 22% tax rate. So that will be an additional $3,525.50 that we are going to add to the $8,907 that we are given in the schedule. So the $8,907 that is given to us in the schedule makes up for all of the income that they have earned at the different tax rates until they get to their 22%. So their total tax liability for 2018 would be $12,432.50. To calculate their average tax rate, we're going to take their tax liability, $12,432.50, and divide that by their taxable income of $93,425, which will give us an average tax rate of 13.31%. And I did round there to 2 decimal places. Their marginal tax rate is going to be 22% because additional income of up to $165,000 would be taxed at that amount. So next we're going to take a look at the basic income tax formula, and our income tax forms will follow this formula. We will also add a little bit more to the income tax formula and expand that in the next chapter. So we're going to start with our income, and from our income we're going to subtract any permitted deductions from our income to give us taxable income. We're going to multiply the taxable income by the appropriate tax rates to calculate the tax liability. From the tax liability, we'll subtract any tax payments that were made and any tax credits that the taxpayer is eligible to claim. And that'll give us either our tax refund or our tax that's due when we file the tax return.